PayPal looks incredibly undervalued with a lot of upside, and it is one I'm thinking about adding to my own portfolio now. We're going to run through the performance of the company. We're going to take a look at how their market share is versus other companies, the Apple Pays, the Google Pays, Amazon Pays. We're going to look at some very important financial metrics, their growth over the last few years. We're going to see whether the institutions are buying or selling this company. What are the insiders doing? Are they selling or are they buying? And we're going to see versus some well-known competitors their performance over the last 5 years. We'll touch upon their health of the company, their total cash versus their total debt. We'll look at their top line growth as well as their bottom line net income. And we're also going to take a look at it through our valuation model, getting to our intrinsic value and getting to our acceptable buy price given our investor margin of safety. Now, it has been hammered down around 21% year to date. We can see over the last 5 days, it is up around 1%. And over the last month, it is starting to make a comeback from those 52-week lows of $50. It isn't one that currently does pay a dividend. And over the last 10 years, if you've been holding this company, you can see you would have been on some kind of a run all the way up to around $310 in summer of 2021 before coming all the way down to the lows of $50. Now, what we can also see here is the actual fact that PayPal Holdings is around 5 times away from hitting their all-time high. So let's jump straight into their income statement, look at their latest earnings to see how this company is performing over the last few years. On the top line, what we like to see, 3 to 7% growth year on year, 15.5 billion reported in 2018, 27.5 billion reported in 2022, and it looks to be around a 10% increase to their trailing 12 months, which seems to be around what we expect for their December 2023. But as always, do hit that subscribe and bell button if you want to be notified of when we do receive the annual report for PayPal for December 23. On a more granular level, we see increases every single year on year, which is always positive to see. The business is growing on the top line and expected again in December 23. And the story on the bottom line net income, well, a slightly different story to be told. 2.1 billion reported in net income in 2018, 2.4 billion in 2022. And on a more granular level, we do in actual fact see an increase to 2020 before a decrease all the way to 22 before an expected increase in 2023. So top line is increasing in terms of the conclusion, whereas the bottom line, whilst it has increased by 20%, we do see the inconsistencies with the increases and the decreases year on year. Quick health check, total cash versus total debt. 9.1 billion of cash and short-term investments in 2018, 11.5 billion from their latest quarterly report, so they are holding a bit more cash than they did 5 years ago. Now compare that numerically and directionally to their total debt. What we can see here is it has gone from around 2 billion to around 11.2 billion, so they are holding a significant amount more debt than they did 5 years ago, and we will touch upon that when we look at our net debt to EBITDA metrics. Now, companies in the same industry, the transaction and payment processings, we have Fiserv, we have Block, we have Aiden, which we also reviewed on the channel recently. Now, year to date, we do see PayPal the worst performing, down 21%. And as we can see, in fact, half of the industry hasn't had the greatest of years, with a few having positive returns. In terms of the last 5 years, what we see, PayPal down, again one of the worst performing, 31% year to date. So they haven't even had the greatest of the last 5 years with another negative return. Do bear in mind though, past performance is never indicative of the future. Now, 0.13% hit institutional ownership. Important to note, around 4.5 million worth of shares were sold by insiders over the last 12 months, with around 2 million of buyers in the same period. So a fair amount of selling, and as we can see, the majority, if not all of that, happening in the latest quarter, Q4, with no buying in Q4. And when we take a look, we can see the majority of this were by Jonathan Orbach, the insider, as well as Peggy, the EVP, and that is there around 70 to 80,000 worth of shares. So quite significant for those that are interested to see those insider movements. Now, in terms of institutions, well, institutional ownership sits at 68%. 11 billion of shares sold over the last 12 months. Same period, we see around 28 billion. So we do see institutions buying more shares than they are selling. But a few things to note. The largest buy did come in Q2. And if we look at the latest quarter, in fact, more selling than buying. So Do understand the data, do look at this and analyze it, but also understand we shouldn't really rely on institutions and copy their movements. Always do your own due diligence. Now, jumping into essentially their metrics, free cash flow per share is what I always draw my eyes to. Earnings is susceptible to manipulation by management through accounting. 132 in 2013, 443 in 2022. It has increased by, in fact, 3 times over the last 10 years. Although do note 2023 is expected to drop down to 285, with 24 expected to be a very strong year. So some things just to keep in mind. In terms of sales growth, well, very nice to see double digits every single year. Although do note in 2022 this has come down to single digits. Now I do like to see 3 to 7% as a minimum, but double digit growth is always strong to see, especially when you're a dividend growth investor. 8% in 2022. 23 expected, again 8%. So a few questions you need to ask yourself, with the more prominent one being, is this a slowdown in the industry, and are we going to be expecting lower rates of sales growth over the coming years, or is this just a blip and we should expect to see this double digit growth again? Now sales, how does that look numerically? Well, 6.73 billion in 2013, 27.5 in 2022, and again a nice increase to 29 billion in 2023. So very strong signs if we do look at the historical data, but do remember historical data isn't a good basis for future. Share buybacks, they do some share buybacks, going from 1.22 billion in 2013 to 1.16 in 2022. So we can see they do reinvest, or in fact give the excess cash to investors. Not that much from what we do see in the majority of companies, but it's still better than nothing. ROIC, 10% or more is what I always say on the channel, always advocate that. It means that management are able to effectively allocate their capital. Last few years, in fact over the last 10 years, it has been in the low essential 10 to 15% target, which is positive to see, especially with 2023 expected to be 14%. So that is nice, in having faith in management and their ability. Operating margin, free cash flow margin, very strong. Operating margin very consistently around 16%. Free cash flow margin between 20 to 25% on average, although do note the free cash flow margin is expected to fall in 2023. In terms of the net debt to EBITDA, well, this shows us the strength of the balance sheet, and what we can see here, this signals the number of years it would take the company to pay off all of their debt net of cash on hand. 0.1 of a year, with 2023 expected to be 0, so a very strong balance sheet. Now we can also jump into their earnings and have a quick look over the last few quarters. Q3 they posted a double beat on the earnings per share, beat on the top line. Q2 they did miss, although marginally, their earnings per share, and they did beat marginally their revenue. Q1 a double beat, very strong to see, and Q4 of 24 they actually missed slightly on the revenue, well, beating on the EPS. Now, what we can see here, if we look at the comparative data year on year, which is what I always like to see, rather than in actual fact the Wall Street analyst targets, revenue, they actually beat Q3 23 versus Q3 22 by 8.4%, although net income did come down significantly, as well as earnings per share and net profit margin. So overall, very mixed, if I have to say and give a conclusion. It is positive to note that they did do a double beat on Q3, and it will be interesting to see how that latest earnings comes in for PayPal and whether or not that will kickstart that growth in the share price. Just 2 things to point out in terms of a lot of people saying that PayPal is outdated. This is essentially for the UK, but this shows PayPal is the second most downloaded app in terms of finance apps on the App Store. And if we look at this data here, it essentially shows us the share of online payment users who use these services in the countries. We have Europe and we have the US. And the one thing to note here is that it is significantly higher at PayPal, as we can see depicted by the green, than Apple Pay, Google Pay, Amazon Pay. And I would be interested to hear your thoughts. Does this surprise you? Personally, it surprised me. I didn't think PayPal was such a big thing in terms of market share and the users that use these payment services. But the receiving theme here is that essentially PayPal is widely used, and by quite some distance. Now, in terms of the valuation, and as always, if you enjoy the content, value is being provided. Do that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, if you do want to grab a copy of the intrinsic value calculator to get to the acceptable buy price and intrinsic value of companies in your own portfolio or on your watch list, do click that pinned comment and grab a copy. So we start off with Graham's valuation model. We have the ticker symbol, the EPS, we have the growth rate per analyst estimates, and that current yield on AAA corporate bonds. to give an intrinsic value of $73. Now, when we take a look at the current trading price, we can see that it's slightly lower than the 52-week high, but again, some nice upside to the current trading price, showing signs of undervaluation, bearing in mind that we're not looking at any of these models in isolation, and we will draw conclusions towards the end. Now, multiple valuation model companies in a similar sector and size that we analyze, we have their PE, we get the average, multiplied by the average or the earnings per share of PayPal, and we get a stock price of $151. Now, that is some significant upside to the current trading price and above the 52-week high. Not as high as the all-time highs, but again, some strong undervaluation in the current market. In terms of the dividend discount model, well, for PayPal, obviously this don't pay dividends, so this isn't a model we will use. We move on to the DCF model, where we have the free cash flows year on year. Average growth rate at 22.5%. We have gone fairly conservative, below analyst targets at 4%. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $99. Again, above that 52-week high, some very strong upside to the current trading price. We then get to the intrinsic value, which is, as always, just the average of the models that we've used in the episode, and this comes to PayPal for $108. Now, with the current trading price, we do see it at around $59. Margin of safety that we typically use, 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data, which means it's a buy up to $97. At 20%, it's still a buy up to $86. At 30%, still a buy up to $75. And at 40%, a buy up to $65. And now what we can essentially see, PayPal right now, per our estimates, is offering a 45% margin of safety. And what do Wall Street say? Well, over the next 12 months, they do see some nice share price appreciation. We can see around 30% up to $85. So in conclusion, what we are saying based on our own estimates and analysis, that we do believe PayPal offers a margin of safety of 45%. And in terms of what Wall Street, well, they see upside of over or around, in fact, 40%, which is very, very strong. Now, personally, PayPal is one that I probably will add to the portfolio. It won't be a large portion of the portfolio. In actual fact, I will start adding a few shares, as I do believe it is significantly undervalued and there is a lot of upside. Now, there are a lot of people who will say that PayPal is essentially irrelevant or outdated, but as we saw there, and there are lots of other metrics and lots of other graphs that you can see where PayPal has a significant market share. But I would be interested to know where everyone is from in terms of what they use, whether it's PayPal, whether it's Stripe, Apple Pay, Google Pay, and whether or not you do believe PayPal, in fact, is undervalued. As always, have a great day. Don't forget to smash that like button if you've enjoyed today's episode. Hit the subscribe button and bell if you want to be continually notified of these videos as they drop. And do click on that pinned comment below so you can grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies on your own portfolio and watch list.